outlines the quality investing philosophy from A to Z, so to speak. What is quality investing? Well, does it work? How can you find these kind of stocks? Plenty of examples. Obviously, quality, very good companies. Well, how to think about valuation. And then the last part of the book is, well, how can you build and maintain a portfolio? Obviously, it's hard to show the book to you like this, but it's a full book that tries to outline the quality investing philosophy. Now, the book today is solely available via Amazon.com, but it's really easy when you go to Amazon.com and type in compounding quality. It will be the first one which appears on your screen, or obviously the name of the book, The Art of Quality Investing. So for you guys, I prepared a presentation where we outline the essentials of the book. And obviously, well, I hope you will like this. The presentation will take around, depends a bit, 45 to 50 minutes. And afterwards, well, there's plenty of time to ask your questions. From time to time, I will also try to look into the Q&A, the live chat on YouTube, and answer your questions right away. And if not, well, we have plenty of room for that at the end of the presentation. So I see we are with a bit over 300 people right now. So that's really good. Thank you for being here. And obviously, I truly hope that you will love the book, because a lot of work. It was a lot of work, especially, and credits to those who deserved. Credits to Le Cruz, was also watching, and a book signing. I will do a book signing in Omaha at the Berkshire AGM at the Markel brunch in Omaha. So for those who are attending the Berkshire AGM, well, really happy to see you there in a few weeks, in 2 weeks actually. Time flies. So very briefly, not that important, but for those who don't know it yet, who is compounding quality? I used to work in the industry for 3 years, but as a matter of fact, well, I didn't like the short-term mindset of Wall Street. I genuinely wanted to do the right thing. As a kid, I always wanted to become a teacher, which is basically why compounding quality launched. So to genuinely help other people, to genuinely do the right thing. And I think, the investing is a beautiful intellectual game, and just helping each other in the community, that's a beautiful thing. And also hopefully they will achieve the same. Now, topic of today, the art of quality investing. So what we will go over the next few minutes is, well, first of all, an introduction to quality investing, right? First things first, what is quality investing? What is the most important thing? We will also briefly go over checklists. So what checklist can you use to find these companies yourselves? How to think about valuation. Then next part, well, how can you build a quality portfolio yourself? And last but not least, well, there will be room for plenty of examples, and also room for plenty of questions in the end. So once again, I will repeat it once more. So what we will go over today is basically a summary of the book, and I genuinely hope you will like it. The book is available on Amazon right now for a bit below $20 USD. So I guess that's not a lot if you know how much work writing a book is. Credits to those who deserve, right? So Luc Cruz, basically I worked together with Luc on this book, and Luc is the author of the book. And I also always laugh with him. Well, what Benjamin Graham is to Warren Buffett, Luc Cruz is to me, because he taught me a lot. He taught me basically everything about quality investing. He's a phenomenal guy. It's the third book he has written right now. The other two were in Dutch. His track record is great. So obviously, the book, it's the entire philosophy. I truly believe in myself, and which is why we work together on publishing this one. And Luc did a phenomenal job. So a digital hand clap for Luc, because he did an amazing job. Now let's get started. Introduction to quality investing. And maybe first and foremost, it's a bit hard for me to look into the comments while talking. So I guess it will be the easiest to do Q&A afterwards. So at the end of the presentation, but no worries, because I will definitely answer every question you have. So Introduction, what is quality investing? Well, to put it briefly, quality investing is all about investing in the best companies in the world. So many of you will know the quote of Warren Buffett. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And that's exactly what quality investing is all about. And as a matter of fact, I also see Warren Buffett as a quality investor, right? How can you do this in 3 steps? Well, it's based on Warren Buffett, once again, on the one hand, Terry Smith from Fundsmith on the other hand. Well, it's 1, buy wonderful companies, 2, led by outstanding managers, and obviously, third point, wonderful companies led by outstanding managers. You try to buy those at fair valuation levels. Next question, or now you've learned what quality investing is. Next question you might have is, well, does quality investing work? Does it make sense? And the short answer is yes, because when you look at the data, you see that, for example, the MSCI World Quality Index, so an index that is based on the regular MSCI World Index, but only picks the quality stocks within the index. Well, this index outperformed by 3.5% per year on average since 1994. You also have a Morningstar Wide Moat Index, and this index, well, what's in the name? It only consists of companies with a sustainable competitive advantage or a moat, while this index outperformed by more than 4% per year on average. And obviously, compounding quality, we also have our own investable universe, and this universe outperformed by 6% since 2005. So many of you know that a lot of professional investors, but also a lot of retail investors, they are not able to perform to perform like the market. They do worse, right? And by just following this philosophy, and as a matter of fact, you can buy an index on the MSCI World Quality Index. You can buy an index on the Morningstar Wide Moat Index. You do 3 to 4% per year on average better than the market. And when you would be able to do this since 1994, like the MSCI World Quality Index, or since 2000, like the Wide Moat Index of Morningstar, well, you will probably outperform 95 to 98% of all investors. So yeah, quality investing is a very straightforward strategy, if you ask me, and it's definitely a strategy that works. Now, obviously, you learned what quality investing is. We learned that quality investing works. Yeah, next crucial step, obviously, is how can you find these kind of companies? And that's exactly what we mentioned in the second part of the book, so the checklist, right? And this is basically the checklist we go over in the book. So on the one hand, you have qualitative criteria, and on the other hand, you have quantitative criteria. So qualitative criteria that can be measured. So think about, the modes, think about pricing power, is it recession resistant, and so on. And then you have the quantitative criteria like the revenue growth, the earnings growth, the free cash flow growth, the free cash flow conversion, and so on. So in the book, and also over the next few minutes, we will go over all criteria, very briefly, of course, and to give you a better view about how can you find these kind of companies. So first and foremost, qualitative criteria. Well, you will see that in the book, we will go over 9 chapters, 9 qualitative criteria you can take a look at to determine whether a company is quality or not. And first and foremost, obviously, start with the beginning. Is the business easy to understand? Does the company fall within my circle of competence? So Warren Buffett also always said, well, always stay within your circle of competence. And how did he define his circle of competence? Well, when 2 criteria are met, on the one hand, obviously, you need to understand how the company makes money. Second point, well, you need to be able to make an educated guess about how the company will look like in 10 years, but also how the industry in general will look like in 10 years. So it's quite obvious that in 10 years from now, everyone will still be brushing their teeth, will be drinking Coke, will be drinking coffee, and so on. But how the market for cybersecurity, for AI, and so on will look like, it's way more uncertain. So it's really important that you only invest in companies you understand, because you can borrow someone's idea, but you can't borrow someone's conviction, right? You always need to make your own homework. And when you just copy someone's stock tip and things start to get tough, so the stock is underperforming, is declining rapidly, and so on. Well, you never will have the same conviction when you just copied someone's idea. And this also means that it gets way harder to stick to your plan when things start to get tough. So is the company easy to understand? Really important. If you don't understand the company, well, never even consider to buy it, and you can skip or cross off the company off your checklist or off your investable universe right away. Second point, diversification. So you want to invest in a company that is well diversified. So well diversified from a geographical point of view, but also the customer base. So you don't want to invest in a company that, for example, where a client accounts for 50% of their revenues, right? That's something you really want to avoid. So international companies with a well-diversified base, active in Europe, the US, Japan, Asia, and so on. That's definitely an advantage. So that's what you want to see. Third point, also a really important one, is the company able to grow? Can it grow at attractive rates? So being active in a growing end market is really essential. So when you know that in the long term, stock prices always follow the evolution of the intrinsic value, and that in the long term, the growth of the earnings and the growth of the free cash flow is by far the most important factor to grow your intrinsic value. Well, in that case, I think that makes complete sense that a company that is active in a growing, attractively growing end market, that those are the companies you want to own, right? So you want organic growth, you want secular trends. So industries like obesity, think about companies like Nordisk and Eli Lilly, digital payments, Visa and MasterCard, urbanization. So elevator companies are benefiting from that. Think about Kone, Otis, cybersecurity. 2 slides ago, I said that the market for cybersecurity is changing rapidly, right? And that's true. But cybersecurity is also definitely a secular trend. So, for example, at Compounding Quality made an investment case of Fortinet. We didn't buy it because we thought the valuation was too expensive. But if you ask me, well, Fortinet is the most attractive quality play in the cybersecurity space. But obviously, valuation can be a problem. But key lesson here, well, ability to grow, really important. You want to invest in companies where the end market is growing at attractive rates, and that the company can grow its organic revenue at attractive rates as well. Maybe just to briefly stop here and check the comments. I hope everything is going okay from your end. If some people could just confirm in the chat, and I think there's a small lag here, but then I can go on and I know that everything is going smoothly. Okay, let's keep going on in this case. Fourth point, and we stopped at maybe one of the most important points here. Well, what is the moat of the company? What is the competitive advantage? And for quality investing, the moat is truly essential. You will never even consider a company when they don't have a moat. So in other words, you don't want to invest in the next big thing. You want to invest in companies that have already won, companies that did really well 10 years ago, companies that are still doing really well today, and companies where you think that they will continue to do very well in 10 years from now. Now, how are you going to quantify the moat? How can you quantify the moat? Well, you want the gross margin to be larger than 40% or having pricing power. Maybe that's even more important than the gross margin. And you want to return on invested capital to be larger than 15%. And when you just screen for both criteria, well, you will find a lot of beautiful companies already, and you will see that you filter out a lot of bad ones already, and that's a great point. And remember the Morningstar White Moat Index. Well, this index outperformed the market very attractively by around 4% per year, and that's exactly what we are trying to do with all these criteria here. You are taking different separate criteria that on their own should already do quite well, And when you combine both, well, you're trying to build an investable universe. And based on that investable universe, you are trying to build your portfolio. And where you can say that, okay, the investable universe, and for compounding quality, for example, it's 148 companies right now. Well, when you would create an equal weighted ETF out of that, well, we would think that in the long term, it would already outperform the market. So moat, really important. How can you quantify the moat? Well, gross margin and the return on invested capital, which are high and also sustainable, so not too volatile. Fifth point, market leader. So also really important, you want to invest in companies with a very strong track record. And obviously, a lot of people are intrigued by IPOs. You want to find next big thing. You want to invest in the next Amazon, the next Apple, the next Microsoft, and so on. But when you look at the statistics, when you look at the data, you see that it's really, really difficult to find the next Amazon, and that you will always or almost always be disappointed. So just stick with the market leaders and trying to do slightly above average for very long periods of time. That's exactly what you want to do with the investment strategy. That's exactly what you want to do with quality investing. That's exactly what we try to achieve here with the art of quality investing, right? So monopolies and oligopolies are very attractive. And also when you look at Buffett's portfolio, for example, when you look at this portfolio, you will see that almost all his current positions and also almost all his historical positions, well, those are companies active in a monopoly and oligopoly. And even if Warren Buffett even does that, well, for us, it can also make complete sense to look into these kind of companies, right? So market leaders are really attractive. Thinking about a company like S&P Global and Moody's here, for example. Pricing power, 6th point, and also a really important one. Why is it so important? Why is it so attractive? Well, pricing power gives you power over your customers. And pricing power is actually also the best protection against inflation. And obviously that was a very important thing over the last few years, right? Where inflation was rising. And when a company has pricing power, when a company has a high gross margin and there's an inflation of, let's say, 7, 8% or even higher, well, it harms a business with a gross margin of, let's say, 15% way more than it harms a business at a gross margin of 80%. So pricing power is really attractive, and it's also a free source of growth, basically, because take S&P Global and Moody's, for example, every year they increase their prices by 4%, their top line, so their revenue goes by 4%, but obviously they also have some operating leverage, so their earnings growth and also their free cash flow, well, it grows by even more than 4% per year. So that's an attractive thing. Other example, See's Candies, so the first quality investment of Warren Buffett. While See's Candies increased its prices every single year since 1972. So really important one to take a look at. And pricing power is also something you want as a quality investor. Skin in the game. So you want companies with skin in the game, companies that are still led by their founder, companies where there's high insider ownership, a family company, and so on. So once again here, when you look at the data, you will see that companies with skin in the game outperform on average. So there is a study of Harvard Business Review that summarizes or that concludes that companies that are still led by their founder, well, they outperform by 3.9% per year on average. What examples? Well, Medpace, Kelly Partners Group, and so on. Or also family companies. Well, Credit Suisse Family 1000 study concludes that family companies outperform by 3.7% per year on average. Think about companies like Brown & Brown, Evolution AB, and so on. So once again, we are combining criteria here, like the moat, like skin in the game, that on their own should already be able to do quite well in the stock market. And by combining them, well, we are statistically seen, rationally seen, we are increasing our chances to do better than the market. 8th point, recession proof. So we will never invest in companies that are heavily affected by commodity prices, like mining companies, gold mining companies, silver mining companies, lithium companies, and so on. We also won't invest in companies active in oil and gas. We seldomly will invest in construction companies. only when it's really, when you feel like it's at the bottom of the cycle, right? So we tend to avoid cyclical companies, and instead you want to invest in recession-proof companies, companies that are really boring, really predictable. So some of you will know the quote of Paul Samuelson. Well, investing should be very boring. Investing should be like watching paint dry. So if you want excitement, well, go to Las Vegas, spend your $400 there. But in the end, you are almost sure that you will lose money. And that's something the house always wins, right? That's something Evolution AB benefits from. So a company we are also invested in, by the way. So, and then the last point of the qualitative criteria is the protection against disruption. So disruption is really the most important enemy for quality investors. You should be really wary about that. You should try to avoid to invest in rapidly changing industries and instead invest in really boring, predictable and profitable companies, right? So a company always needs to keep innovating. So think of, for example, the example of Netflix versus Kodak. Well, Kodak was a clear market leader 25 years ago. A Kodak moment was even referred to as taking the perfect picture, right? And Kodak didn't invest in the digitalization of pictures. And well, we all know the results. So today, Kodak is only a fraction of itself. So a really dangerous one. And maybe also to add here, we are talking about quality investing here. So wonderful companies led by outstanding managers. Obviously, the market often recognizes quality. So as a result, the valuation is a bit higher than what you are used to. But when disruption happens, well, the company's growth of the intrinsic value will slow down, and the market will recognize that. So the multiple will also come down. And when you have that, well, you have a double-edged sword, and things can go down quite fast. So the valuation comes down, and the intrinsic value per share growth comes down. Well, that's a really dangerous thing, and that's what we have seen with Kodak, for example. But on the other hand, well, we have Netflix. Netflix evolved from being basically a service provider of delivering DVDs at your house. And today they evolved to being the largest streaming platform in the world. So companies always keep innovating. Same for Amazon. Nobody could have predicted that they would evolve from a loss-making online bookstore to the largest e-commerce player in the world. But that's what happened. And so a great company culture, a very innovative culture is probably really important. And these are the 9 points, or these are the 9 points for the qualitative criteria. And I see that 400 people are looking, so that's really good. Truly appreciate it. And obviously, I also hope that you will all love the book. And like I said, plenty of room for questions after the presentation. So in the book, first part is the qualitative criteria. Next part of the book are the quantitative criteria. So criteria that are measurable. And we have 4 here. Well, the first one is attractive revenue and EPS growth. Why is it so important? Because in the long term, stock prices always follow the evolution of the intrinsic value of a company. And the evolution of the intrinsic value of a company is by majority driven by earnings growth and free cash flow per share growth. So we are going to quantify this, and we want revenue growth to be larger than 5% and earnings growth to be larger than 7%. And you want this to be the case in the past. So where in the past the company managed to grow at these attractive rates, but also where this is the case in the future. So where you make, where you estimate that they will keep growing at very attractive rates in the future. So we talked about the secular trends here, obesity, urbanization, digital payments, and so on. So it goes without saying, and I'm a cyclist, for example, that when you are active in an attractively growing end market, well, it's way easier for you as a company to grow at attractive rates as well. It's cycling when the wind is with you, it's way easier than when the wind is against you. So when the end market is growing, well, for you as a company, it's also way easier to grow at attractive rates. Next point, you want most earnings to be translated into free cash flow. And this is a snippet from Jeremy Seigel's book, Stocks for the Long Run. And he concluded that companies that translated the most earnings into free cash flow outperformed companies that translated the released earnings into free cash flow by 18% per year. So that's a phenomenal figure. So free cash flow is really important, a way better metric than earnings, for example. And once again, we are here taking a metric that on its own should do quite well in the long term. And when you combine all these criteria, well, you are building an investable universe that should be able to do quite well. Small side note here, we want free cash flow conversion to be really high so that most earnings are translated into free cash flow. But when a company is heavily investing in future growth, so when a company is, for example, in an extreme situation, investing everything in organic growth, or reinvesting in itself, well, in that case, obviously the company can even have a negative free cash flow and the free cash flow conversion will be low. Well, that's something you need to take into account because that's actually what we want, right? We want great companies that can reinvest everything into the business. And take, for example, Dino Polska. Well, until last year, Dino Polska had a negative free cash flow, but it's still a quality business. And then in this case, well, the free cash flow conversion, looking into that, doesn't make too much sense. Anyway, third point, and maybe with return on invested capital, the most important point is the return, together with the most return on invested capital is the most important thing. So return on invested capital gives an indication about the company's moat and about the company's sustainable competitive advantage. So you want this metric to be very high and very sustainable. And when this is the case, well, it shows you that the capital allocation skills are really good. And yeah, like I said, a high return on invested capital in combination with a competitive advantage can be something really powerful. That's exactly what we want here with the art of quality investing, with the quality investing philosophy. And then the fourth quantitative point, well, a healthy balance sheet. You want companies that are in good financial shape. So a healthy balance sheet gives companies flexibility. And what you often see is that those kind of companies are so good, they are so profitable, they are pouring out so much cash that they basically don't know what to do with the cash, and that they even have a net cash position in that case. So more cash than that. And obviously that gives you a margin of safety as an investor, something that's really important. You also see it on the slide here. We are also quantifying this. So we want the interest coverage to be larger than 10 and the net debt on free cash flow smaller than 5. And when this is the case, well, we consider a company as a healthy company, and that's what you want. So obviously we talked about the introduction of quality investing checklists, so the qualitative criteria and the quantitative criteria. Next part here is the valuation. So obviously quality is often recognized by the market. It's trading at somewhat richer valuation multiples, but yeah, sometimes it would be very naive to say that a company with a PE of 10 is cheap and a company with a PE of 25 is expensive. You always need to look at the whole story about the balance sheet, the profitability, capital allocation, the outlook, and so on. So what we are trying to do here is we are trying to buy wonderful companies at a fair price. And how are we going to do this? We always use 3 models to look into the valuation of a company. First one is very naive, very, very simple, I guess. It's just comparing the company's PE with its historical average, just to get a first quick grasp about what the valuation of the company looks like. Second one is an earnings growth model. And third one is a reverse DCF. So really important, so we'll briefly go over them all. First one, really easy one, is comparing or looking at the evolution of the forward PE. So right here, for example, we see the forward PE of a company within the portfolio. Well, you see that it's trading near its cheapest valuation levels ever. This is also already something we like to see. So you wouldn't like to see it the other way around, that it's trading at an all-time high. But once again, obviously, you always need to look at the entire situation. For example, maybe the company is trading cheaper right now because the outlook looks worse than it used to be, and so on and so on. So this method, just looking at the forward PE, is just an indication, and that's why you are going to look at the next 2 things. So next 2 things, earnings growth model, really important one. So in theory, it's really easy to calculate your expected return as an investor. Your expected return is always equal to company's earnings growth plus the shareholder yield, when the shareholder yield is a dividend yield plus the buyback yield plus multiple expansion or minus multiple contraction. I will repeat it because it's really important. Your return is always equal to the earnings growth plus the shareholder yield plus or minus the changes in valuation. And I understand that this might still sound a bit abstract, but I will give you an example to make it a bit more clear. Well, let's take Evolution AB, for example. In our model, we stated that the earnings growth over the next 10 years should be equal to 14%. So growing at very attractive rates. For the shareholder yield, we just look at the average shareholder yield over the past 10 years, which is 0.4%. And I think that Evolution AB is a bit too expensive today, and that the PE or the forward PE should decline from 21 times earnings to 20 times earnings over the next 10 years. Then we take the formula, earnings growth plus shareholder yield minus multiple contraction in this case. So your expected return is equal to 14%, which is the earnings growth, plus 0.4%, the dividend yield, minus the change in the valuation. And when you do these calculations here, shown on the slide, you get an expected return of 13.9%. And then the question you need to ask yourself is, well, would I be happy with the return of 13.9%? If this is the case, you should consider investing in the stock. If not, you should look for other opportunities. And obviously, the output here, the 13.9% return, this is the output based on my calculation, based on my assumptions, right? So those might also be wrong. So please do your own due diligence and make your own model with the expected earnings growth and so on. But I hope that this example made the philosophy of the earnings growth model clear. Third model, maybe the most important one, is the reverse DCF. So Charlie Munger always said, well, if you want to find a solution to a complex problem, you should always invert, turn the problem upside down. And that's exactly what you are doing with the reverse DCF. So many of you will know a classic DCF. And with the reverse DCF, you basically just invert, you turn it upside down. So what are you going to do? You are going to execute classical DCF where the upside potential is equal to 0%. So when you do this, you basically just use all the market numbers. And the next thing you are going to do is you are going to look at which free cash flow per share growth the market is expecting over the next decade. So the growth that is implied in the current stock price, basically. And then the third and last step you should take is, well, you just try to determine whether this implied growth rate, which is implied in the stock price, is realistic or not. Once again, I can understand that when this is the first time that you heard about the reverse DCF, it sounds a bit complex, but I hope that the example on this slide will make everything a bit more clear already. So here, partners of Compounding Quality know that you can download the Excel sheet. Well, here we executed a reverse DCF for Evolution AB, and what you see is that there is a growth rate of 8.8% implied in the stock price right now. I am circling around it. And then the question is, well, do we think that Evolution AB can grow by 8.8% per year? And for me, well, I guess that Evolution AB can grow by more than 8.8%, 12, 13, 14%. So this indicates that the company is undervalued right now. And that's why why I am owning the company, for example. So valuation, yeah, most important thing, we try to buy wonderful companies at a fair price. And we use 3 models to do this. Looking at the evolution of the forward PE, earnings growth model, and then the third part is the reverse DCF. Now, everything good. We learned about what is quality investing and does it work? Criteria you can use to find quality stocks, how to look at the valuation, and then at the last part of the book is how are we going to build a quality portfolio based on what we have learned. And this is the next part of the slide deck here. So how are you going to build a quality portfolio? And for example, what we always do is, or what at least I always do is, worldwide, there are 60,000 listed companies. And I think we can all agree nobody has time to analyze 60,000 companies. So what we are doing here is we are using a stock screener to try to remove all the weeds or the bad companies and to try and remain with only the beautiful companies or the flowers. So, and we are using these criteria here. So you want a revenue growth larger than 5%, profit growth or earnings growth larger than 7%, high free cash flow conversion, so free cash flow on earnings. But remember, always be cautious with companies that are reinvesting everything back in the business in this case. Return on invested capital larger than 15%, really important. And then last part, a healthy balance sheet. So net debt on free cash flow smaller than 5, and debt on equity smaller than 80%. And what you will notice, and by the way, this is output from FinChat. What you will notice is when you use these criteria, so on this slide, is that you will remain over with about 250 companies, and the companies that still remain, they are quite good. So you see Apple, you see Microsoft, you see Visa, you see ASML, Hermes, and so on. And by the way, this list is a screenshot and it's filtered by market cap. So there are also a lot of beautiful companies within the small and mid cap space that remain. And once again, I would be comfortable to state that in the very long term, so 10 years, 20 years, and so on, when you would create an equal weighted portfolio with those 250 companies that match these criteria, well, you will probably, your results would be quite well. So that's something interesting. So where you are building an investable universe and on its own, hopefully already does quite well. And based on that universe, you are looking into these companies further, right? You always need to do your own homework. And based on that, well, you are building your portfolio, and hopefully your portfolio can still even form even better than the investable universe, right? So your stock selection framework looks a bit like this. So I always love investing is all about saying no as soon as possible. So worldwide, you have 60,000 listed stocks. You only want to invest in companies that are within your circle of competence. So if you don't understand how the business makes money, cut them off right away. Then you are using the stock screener. Then maybe only 250 companies remain. Next part, well, remember the 3 steps to find quality. Buy wonderful companies led by outstanding managers, trading at fair valuation levels. Second step is the skin in the game part. So you want to invest in companies led by outstanding managers. Then only a few companies remain, and then it's the art to invest in those that are still trading at fair valuation levels, right? So remember, buying wonderful companies at a fair price. Just checking in the comments here, and everything looks good. So I'll just go on at this point in time, and then make some room for the Q&A at the end. So when you look at the compounding quality portfolio, you will see that there are 3 buckets in general: owner-operator stocks, monopolies and oligopolies, and then third part, the cannibal stocks. So first one, owner-operator stocks. Owner-operator stocks are stocks that are still run by the founder or where insider ownership is larger than 10%. This is by far the most important pillar, probably 60 to 70% of the portfolio. Why? Because companies with skin in the game outperform by a wide margin. So you have companies like Medpace, which did really well recently. Kelly Partners Group also did really well. OTC Markets, we will touch upon that one in the next few slides. Brown & Brown, Evolution AB, and so on and so on. So here, once again, a slide out of the slide deck of Kelly Partners Group, by the way, that shows that companies with skin in the game outperform by a wide margin on average. And that's exactly what we also want to achieve. Second bucket, monopolies and oligopolies. So companies or industries where only one or a few companies dominate the entire industry can be really attractive. And they are usually great investments because they have a lack of competition, obviously, but also pricing power. And pricing power is really attractive, really important. That's also what Charlie Munger once said. Well, when you found a company, well, you can find a company with untapped pricing power. So a company that have pricing power, but that they didn't use it to full force yet. Well, those investments are usually truly great. And that's what we are looking for. So on the one hand, the golden goose is really the quality stocks with plenty of reinvestment opportunities. But on the other hand, companies, quality stocks with a lot of pricing power can be really attractive as well. So think about S&P Global and Moody's, think about Visa and MasterCard. So today it has basically become impossible to take away the market dominant position of Visa and MasterCard because it would cost so much for disruptors that it's basically impossible. And often you see a lot in the newspapers, for example, that there's a new fintech company that might disrupt Visa and MasterCard. But what you see all the time in the end is that they end up working together with Visa and MasterCard because they need them in order to grow. And it shows once again how powerful their business model is. Already briefly touched upon this one. So when you look at Warren Buffett's portfolio, well, you will notice that almost his entire portfolio is invested in oligopolies and monopolies. So if even Warren Buffett thinks it's attractive, if even Warren Buffett thinks it's interesting, well, in that case, we should definitely too. So monopolies and oligopolies can be very attractive businesses. And then we arrive at the last bucket, and maybe the least well-known bucket, cannibal stocks. So cannibal stocks are quality stocks that are heavily buying back their own shares. And why can this be interesting? Well, first and foremost, maybe it's really important to understand that share buybacks only create value when the stock is undervalued. So with share buybacks, the company buys back its own shares, right? And it's the same for you as an investor. When you buy a company, you also only generate an attractive return when the company is undervalued, and the same goes for the business itself. But when the business is actually undervalued and they are trading, if they are trading at cheap valuation levels and they are heavily buying back their own shares, well, in that case, yeah, you have some leverage on the value creation for you as a shareholder. It can create a lot of shareholder value. And like the quote of Charlie Munger here, well, pay close attention to the cannibals, something really attractive. What are some examples? Well, Ameriprise Financial, a company active in wealth management, AutoZone, Ulta Beauty, and so on. So here on the next slide, you see the evolution of the outstanding shares of AutoZone, and you see basically halved their outstanding shares over the past decade, and they bought back almost 90% of the outstanding shares since 1990. Well, that's an attractive figure. And what I can tell you, and you can also look up the stock price, AutoZone is definitely a company you would have liked to own if you didn't over the past decade and over the past 30 years. So you learned about what quality investing is. You learned about the checklists. You learned about valuation, how to think about valuation, how to build a portfolio. And let's take the last 10 minutes before the Q&A to give you 3 examples. So first example I brought to you is Ulta Beauty. So Ulta Beauty is a US beauty retailer, very well known in the US. So they have over 25,000 products and more than 600 beauty brands, and one of the best in class loyalty programs in the US. So to put that into perspective, for example, the loyalty program of Ulta Beauty is larger than the one of Starbucks, for example. Now, what's the key investment thesis in this one? Well, Ulta Beauty is a quality business. It's a compounding machine, so low capital intensity, attractive margins, great capital allocation, and so on. But the most important one and the most attractive thing, and definitely at the end of last year, because the valuation was really cheap, the valuation was really cheap back then, and they are heavily buying back shares. So over the next few years, they will probably use 90 to 95% of their free cash flow to buy back shares. And when you can do that at cheap valuation levels and you are still growing a bit organically, well, beautiful things can happen to the business. Beautiful things can happen to you as a shareholder. So when you look at the earnings growth model, for example, well, we went over the reasoning of the formula. Well, you get an expected return of 9.5% per year today. So in other words, we expect a yearly return as a shareholder of 9.5% per year. If you are happy with that, you should consider, or you might consider, investing in the company. If not, well, look for more attractive opportunities. And when you look at the reverse DCF, you will see that Ulta Beauty needs to grow its free cash flow by around 8.5% per year in order to justify the current stock price. But once again, at these valuation levels, when Ulta Beauty keeps using 90 to 95% of their free cash flow to buy back shares, probably free cash flow per share will already grow by around 7.5% per year on average. And combine this with around 4% organic revenue growth, that's more than the 8.5% that is implied in the current stock price, which is why we are still invested in this one today. Next company is OTC Markets, and OTC Markets can be seen a bit as a New York Stock Exchange for smaller companies. So the New York Stock Exchange for OTC products in the US. What is the key investment rationale here? Well, Cromwell Coulson is an amazing guy. Talked with him a few times, talked with him a few months ago. So he is the CEO since 1997. So been doing this for over 25 years. He owns around 45% of the business, and he really thinks and acts like a shareholder. So when I asked him, for example, about something, a decision they made recently, or last year actually, and a decision that didn't went well. Well, he said, yeah, I asked him, what's the reason for that? He said, well, because the CEO made a mistake and he should be punished for that. So that's when you are daring to admit your own mistakes. That's something really beautiful. Something other interesting to know is that people that were invested in the Buffett partnership in the 1960s, they're also invested in OTC markets today. Honestly, we need to say more than 60 years ago invested with Buffett. Those people are at age right now. That's probably an understatement, but it shows you what kind of business OTC is and a company we definitely want to be associated with. So when you look at the earnings growth model, well, expected return of 11.2% per year, and the reverse DCF, well, in the reverse DCF, it states that OTCM needs to grow its free cash flow by 9.2% per year in order to return 10% per year to shareholders. Well, in my models, in my estimates, I guess that OTCM should be able to grow its free cash flow by 11 to 12.5% per year. So that's more than what is implied in the current stock price. Last example, Kelly Partners Group. And for those who are going to OMA, well, Kelly Partners Group will also give a presentation there. Kelly Partners Group is a phenomenal business. It's a serial acquirer in accounting businesses. So they are offering accounting solutions. And it's a decentralized business model with a partnership model. So a bit like Berkshire does it, a bit like Constellation does it, and so on. So Brad Kelly is an amazing guy. He's really, really ambitious. He always states, well, I want to build the Berkshire Hathaway of accounting, to put high expectations, right? But he founded the company. He still owns, almost 50% of the shares, basically. Insiders own 60%. The company tripled in size every 3 years on average since their IPO. So it's a phenomenal business. It's a small business, still growing at very attractive rates. And when you look here at the earnings growth model, well, expected return 12.6% per year. And the reverse DCF, well, KPG is a bit expensive but it's because they are growing at such attractive rates. And then we see in the reverse DCF, you see that the free cash flow should grow by 13.6% per year in order to grow by 10% per year. But I guess that they can go faster than that. Side note on this one, KPG performed really well this year, performed really well year to date. So personally, I wouldn't definitely be in a hurry to pick up this one, but it's an attractive business for sure. So I guess this was the most important thing of the presentation. So yeah, we worked really hard on this book. It's available on Amazon. So if you scan the QR code or you go to Amazon.com, well, you can find the book and you can pick it up. It would be truly lovely if you could do, because yeah, obviously it was Charlie who said their answers were billions of dollars in a $20 or $30 history book, right? Basically, yeah, we spend a lot of time on this one. It's only $20, which is probably really cheap, given that you know that and especially Luc, because Luc did 99% of the work on this one, but that he worked months and months on this one, and you can buy it for $20. I think that's the phenomenal part. So available on Amazon. And I guess with this, I will leave the floor for Q&A, and hopefully you learned something new. Hopefully you learned the book. And from my side, I truly enjoyed the presentation. I hope you learned something new as well. And then let's open it for the Q&A. So I'll hop into the chat and see which questions pop up. Okay, where shall I start? Shidam is asking a question about where do you find the insider holding percentage of a company? Well, really tough to find this one on stock screeners. The most efficient way to do this for US companies is probably to go into the proxy statement. So for example, when you just Google Apple proxy statement, probably the first hit you will find on Google will be the proxy statement. And if you do Control F and Control F for beneficial ownership in that case, well, you will find the insider ownership within 90 seconds. So that's probably the best way. It's also the official insider ownership, because when you just Google for insider ownership on websites like Yahoo Finance, Guru Focus, and so on, the data are often wrong. So for insider ownership, I will definitely look into the official proxy statement of the company. Mm-hmm. It's tough. It would be easier if someone could ask the questions to me instead of me reading it. But next question from Sasha Meyers. Well, you indeed you asked margin of larger than 40%. In that case, you won't find companies like Costco, for example, and yeah, Charlie Munger really loved Costco. I think that's a very good question, Sasha, and it's a very relevant one. So what we do with criteria is we are trying to build a framework to find great companies. But you are 100% correct that by doing that, you exclude a lot of companies like Costco, for example, like Dino Polska also in the space. So that's why it's important that you can't just make investment decisions purely based on the stock screener. You always need to make your own homework. And for example, when a gross margin is 38% and not 40%, it's definitely not a no-go. You just need to look at what kind of business is it? What is the reason that the gross margin is really high or really low? So there is no golden truth for investing. And it's also once you start to become a bit more experienced in investing, you can also play out with the filters a bit. So for example, instead of a return on invested capital larger than 15%, you can look for return on capital employed, or you can maybe try to exclude cash and goodwill out of return on invested capital and see how the output looks in that case. But what I can tell you is that what I believe is when you are using these criteria, you will find a lot of great companies. But obviously, you will also exclude a lot of companies that are actually quite well. But in that case, well, try to find a bit different variants of the stock screener. And when you, as a quality investor, would dive into a company like Costco, well, it would definitely fit your criteria. So I also think that you're right, and it's definitely a great business. Kindle version available since yesterday. The Kindle version of the book should be available. So when you go to Amazon.com, you will see that there is a paperback available, and also the Kindle version. So right here, I'm on the Amazon.com website, for example. Like you can see here, there's a Kindle version and there's a paperback version. By the way, obviously, for those, yeah, I think the most important thing for Luc and myself to make the book a success is to get some reviews in the beginning. So when you ordered the book, when you read the book and you liked it, it would be a true honor if you could give a review, and that would be, yeah, really helpful for us, and it would be a big advantage. Excel spreadsheet you showed in the presentation. A question from Jordi Garcia. basically the most, for example, you have the spreadsheet or reverse DCF. We also have the spreadsheet of the investable universe. Those are only available for partners of compounding quality. But for the reverse DCF, well, willing to make an exception, maybe you can send me an email, just reply on one of the emails you get from me, and I can send you the reverse DCF template, and you can use that as well. Anton Gonzalez asks the question, is institutional ownership important to you in buying a decision for equities? For me, it's not. So I worked in the industry for 3 years. And I think from my part, that in a huge part, we know that there are a lot of really, really, really bright people working in the industry. They're working 60, 70, 80, or even 90 hours a week researching stocks. And still, when you look at the data, 90% of them underperform the market in the long term, right? That's not because those guys aren't smart, because they are really smart. But the problem is probably that they think on the short term. There are some commercial incentives and so on, and that's actually the big advantage we have. Is we can think on the long term. We don't need to justify to clients when something doesn't go well. And what I also noticed is, for example, last year, for those who still remember, during the Berkshire AGM, Buffett said, well, go where competition is weak. And Buffett also said, when I would only manage 1 million today, I would have no problem to make a return of 50% a year. And Munger replied, I think he's right. And I also feel that one of the main things I learned from working in the industry is that everyone is looking at large cap companies. For me, even I was involved in a rather small fund, 200 million in assets under management, and even you don't invest in companies with a market cap under 10 billion. And for a fund I was involved in, that's only peanuts, right? So all the worldwide equity funds that are looking and investing into Amazon, Apple, Microsoft, and so on, and almost no one is looking at the small and mid-cap space. So when you can really do your own due diligence there, make your own homework there, I think beautiful things can be found, because the market is way less efficient there. And also, the returns on average are higher there. So small caps can definitely be also something attractive. Question about emerging markets. For me, I don't invest in emerging markets because the first rule of the qualitative criteria, always stay within your circle of competence. I don't consider EM within my circle of competence, so I don't know it well enough. So when you want to invest in EM, I prefer to do that via established companies in the US or Europe that have a huge exposure to the emerging markets. Think about LVMH, for example, that obviously benefits from a lot of sales in EM and from the rising middle class there. Question: return on capital employed versus return on invested capital from Method. That's at least what he's called in the chat. Fair question. So personally, I'm more a fan of our return on invested capital, but some of you will also know that for example, Terry Smith always look at the return on capital employed. Well, I think that's, both metrics are fine as well. They are both good metrics. And once again, it's an important one. You can start playing out with the metrics for a while. So for example, here, going back a bit, here you see, for example, that I screened for return on invested capital larger than 15%. What you can also perfectly do is calculate or use a return on capital employed larger than 15% or even 20%. And when you do that, you will see that you'll find slightly different results. That you maybe find new companies that are also very interesting that you didn't find during your first screening criteria. So in general, I wouldn't use return on assets, for example. Look also expanded on that in the book. Return on assets is actually a very bad metric. Return on equity can also be a dangerous one because due to share buybacks, the company has incentives to bring down the equity part and increase the debt part to increase return on equity, right? So don't use return on assets, be a bit wary of return on equity, but I think return on invested capital and return on capital employed are definitely great metrics. Anton Manuel asks, how can you calculate a company's reinvestment rate? Well, really easy actually. And also, once again, fully explained in the book here. How can you calculate a company's reinvestment rate? You can calculate a company's reinvestment rate by taking the required growth rate and dividing it by return on invested capital. So when you have a company that can or wants to grow by 10% per year this year, and they have a return on invested capital of 20%, it's 10% divided by 20%, so it's 50%. So in this case, the reinvestment rate is 50%, and the other 50% the company can use for other things like dividends, share buybacks, and so on. And this also shows you why return on invested capital is so important. If you have the same example, but the return on invested capital is 50%, you take the growth rate, 10% again, divide by return on invested capital of 50%, 10% divided by 50% is 20%. So this company only needs to reinvest 20% to grow at 10% per year. And they can use 80% for dividends, share buybacks, and so on. And that's also why it's so rare to find a quality company that can reinvest everything back in the business. Quality companies are often so good businesses, and they are low capital intensity, great capital allocation, growing at attractive rates, and so on. But they require so little capital to grow at attractive rates that they are pouring out so much cash and they don't know what to do with it. So, for example, right now, there are probably two great examples of companies that can reinvest, quality companies that can still reinvest a lot in the business. And these two examples are Copart and Dino Polska. So when you can find a quality business that can reinvest a lot back in the business, that's a compounding machine, as Chuck Akre called. It's the golden goose. And when you can find these kind of companies at reasonable valuation levels, well, that's a beautiful, beautiful thing. Charles Luquet asked, is LVMH a quality company? Short answer, yes, I think it is. So it's also in the investable universe. And spoiler alert here. Well, on Sunday on the website, there will be an article about the 3 favorite stocks of Le Creuser, so the author of the book here, and he also tips LVMH. So stay tuned for Sunday to get a full explanation about LVMH, I would say. Still looking for interesting questions. Obviously, I can't probably answer them all. Meebe says, I think he owns Admicom. That's not true, by the way. So if there are still questions, feel free. I'm scrolling through them all. And so, yeah. Anton, you based on the institutional ownership part, you say the lower the institutional ownership, the better. I wouldn't go that far, but I just don't take it into account too much. So I don't look into it too much. Also, when you look at the analyst reports and so on from large institutions, to me the quarterly results are just noise. And what we try to do is look into quarter decades instead of quarters. So really think on the long term. And that's the main difference probably between, for example, Wall Street and Warren Buffett. And if you want to do well, I guess you should try to be more like Warren Buffett instead of Wall Street. Tesla, no opinion about that, or definitely not invested in the company. Okay, during the presentation, also a few questions came, obviously, but I didn't see them all. Maybe what I will do, I will leave the chat open for 2-3 minutes and see what comes in. I will still answer that. Small caps to follow. Yeah, we have the investable universe, right? So I like small and mid caps when we can find attractive quality companies in small and mid cap space. Definitely taking that one. How many companies should you own? Well, Buffett says 3. 8. Well, probably the more experienced you are, the more concentrated your portfolio can be. Academical research has proven that when you own 20 to 25 companies, you diversify away the most risk or the diversification, the benefits of diversification are almost reached. So for me, for compounding quality, for me personally, I am looking for a portfolio of 15 to 20 stocks. When you want to own a portfolio with 8 stocks, that's definitely doable. But in that case, you should know really, really well what you are doing, because when then your investment you made a wrong assessments about the company. Yeah, obviously, when you only own 8 companies, it can be dramatic to your returns. Dun, dun, dun. Geopolitical risk, yeah, just bottom-up stock pickers. So I don't care too much about the macroeconomy. It was Peter Lynch who said, well, if you spend 30 minutes a day, a year, if you spend 30 minutes a year on economics, you wasted 10. So I agree with him. So when you can find, or when you found a company, there is a wonderful business led by excellent managers at the fair valuation level, I will probably buy it no matter what is happening in the geopolitical space. So it's also what Warren Buffett said. Well, over the past 200 years, we had 2 world wars, several hurricanes, a pandemic, and so on and so forth. But still, the stock market, well, it returned around 7 to 9% per year on average. Amazing results. So just keep focusing on the long term, and the long-term stock prices will probably keep doing well. Maybe let's take one last one before we turn off the presentation. Um, dum, dum, dum. Yeah, maybe a one from Cocky. Well, how do you determine how much to invest in each company? Based on your conviction. What I personally do is I use a 15-step framework, 15 criteria to give a company a quality score on 10. And the higher the score, the better, and the higher the weight within your portfolio. And I'm also a big fan of letting your winners run. So let your winners run and cut your losses as soon as possible. I think that's really important, really good advice. So for example, when you take, I would also have no problem when a company does really well and goes to 10, 12, 13, 14% of your portfolio just because of your performance. So portfolio allocation is a very important thing. Something a lot of people are also asking questions about. And let's write an article about that one in the future as well. And I see one question about Amma and one about Kinsale from Peter de Neve, which is a great friend, by the way. Kinsale Capital, wonderful company. Valuation looks quite expensive. So this morning I was actually working on the full investment case. So that should be published in the near future on the website. But it's definitely a company that's not cheap. So definitely not in a hurry to pick it up. Hopefully valuation comes down, and that's what we love to see. By the way, also the market is currently in fear mode. So also that's something we like to see, right? So the cheaper the price we can pick up quality companies, the better. And then one last question. Is about Omaha. So for those who are going, I'm also going, and I will bring as many physical copies as I can about the book. So we'll be there from Thursday to Monday, and on Sunday at the Markel brunch, which is, by the way, if you're going, it's a really interesting event. I will do a book signing of the book at the Markel event. So at the event of Tom Gaynor, and I'm happy to see you there also trying, and I think Pavel is also in the meeting here. I'm trying to get some friends of compounding quality together and grab some dinner or at least some drinks on Sunday afternoon. So let's try to make it happen. Let's conclude the webinar. Let's conclude the presentation. Like I said, I hope you liked it. If you still have questions, feel free to send an email or send it in the Slack community from all partners. Like I said, would be an honor for those who are interested in the book to learn that way. Would be an honor to get reviews on Amazon. And for the rest, I would say thank you very much for your time. Thank you very much for listening. I hope you learned something, and let's talk again soon. So have a very nice afternoon for those in the US. Have a very nice evening for those in Europe. And talk to you soon.